right, let's talk about cracking the code on one of life's biggest level ups, buying a house. Now, forget everything you've heard, because you don't need a giant pile of cash to pull this off. What you do need is the right strategy guide, and that is exactly what we are about to open up. I mean, let's be real, buying a house kind of feels like the final boss of adulting, doesn't it? It's this massive, intimidating challenge that seems, almost impossible. But what if I told you there's a way to actually win this thing? Okay, so let's dive right in. Every good quest, every adventure, it starts with a big, scary monster. And in this story, our monster is the price tag. So just how big are we talking? Get ready for this. $206,250. Yeah, that's the price of the house in our example. It's a number so big, you feel like it should have its own dramatic theme music playing. I mean, seriously, that is a very intimidating pile of money. It's a true boss-level obstacle that makes you wonder, how could I ever save up that much? But here's the secret. You're not supposed to fight this boss alone. So, you know how in every great video game there's a secret weapon or power-up, maybe even a cheat code that lets you beat the level? Well, in the world of home buying, that cheat code has a name. It's called a mortgage. The easiest way to think about it is this. A mortgage is basically a subscription service for your house. It's just a formal contract where a bank loans you the money to buy the place, and you pay them back over time with monthly payments. It is literally the key that unlocks the door. But here's the thing. Not all cheat codes are the same. When it comes to mortgages, you have different options, and you really got to pick the one that matches your personal style. The two main flavors are fixed rate and adjustable rate. So a fixed-rate mortgage is like playing as the tank character in a game. It's super stable, it's predictable, your payment is locked in, and it never, ever changes. An adjustable-rate mortgage, that's more like playing a high-risk gambler. Your rate can change, so your payment might start out really low, but it could also spike way up later on. It's a much riskier way to play. So, to put it super simply, with a fixed rate, what you see is what you get for the entire loan. With an adjustable-rate mortgage, or an ARM, the rate is tied to the market, so it can go up or down. One's all about stability, the other is a gamble. Okay, now it's time to learn the controller combos. And don't worry, even if you hate math, this is the part where you see how a few simple numbers can save you thousands of dollars. Seriously, this isn't homework, it's a financial superpower. To figure out what you'll actually pay each month, you only need to know three key things. First, how much money you're borrowing. That's called the principal. Second, the interest rate. That's the fee the bank charges you. And third, the term, which is just how long you have to pay it all back. That's it. Okay, so for our example, remember the house costs over 200 grand? Well, we're only borrowing 80% of that, so our first input, the loan amount or principal, is $165,000. Our second input is that interest rate. For this 30-year fixed rate example, the rate is 4.125%. This is basically what we're paying the bank for letting us use their money to buy our house. And finally, the time frame. We're looking at a 30-year loan. But just to make it sound a little more epic, that's 360 months, 360 payments, and then the house is all yours. All right, we've got our three key inputs locked and loaded. We've got the principal, the rate, and the time. We hit the calculate button, so what's our monthly mission gonna cost us? $796.93. That's it. That is the monthly payment. And all of a sudden, that massive, scary six-figure number we saw, it gets broken down into something that feels, well, a lot more doable, right? So that number feels pretty manageable. But remember, that was for just one type of loan. Your choices here really, really matter. Picking a different loan is like picking a different character in a game, and each one has totally different stats and different outcomes. So let's head to the character select screen. Check out these stats. The 30-year loan has the lowest monthly cost, okay? But hang on. Look at the total damage to wallet. Over $121,000 in interest. Whoa, that's the hidden cost. The 15-year loan, yeah, it has a higher monthly payment, but the total damage is way less because you pay it off faster. And those ARMs? The interest looks super low, but that's a potential trap. It only covers the first few years. After that, your payments could totally skyrocket. Let's just focus on the two fixed-rate players for a sec, because this is wild. Just look at this difference. By choosing the 15-year plan and just handling a higher monthly payment, you save almost $80,000 in interest. That's not pocket change. That's a new car. It's the ultimate trade-off, a lower monthly payment now or a much higher total cost later. So what have we actually learned here? What's the big takeaway?
Well, by understanding just these few key ideas, you've basically unlocked a new skill, a financial superpower.
In the end, it all comes down to this. These three things: the time frame, the interest rate, and the monthly payment. These are the strategic levers that you can pull. And learning how to balance them is the absolute key to winning this game and making the best choice for yourself.
See, this whole thing, all these numbers, all these percentages, it's not about passing a test in school.
It's a real world life hack. Understanding this stuff turns math from something you have to do into a powerful tool you can actually use to go out and build the life you want. So you've seen the map, you know the cheat codes, and you've met all the players. That final boss of adulting doesn't seem so scary anymore, does it? Now that you know the rules of the game, the only question left is, how are you going to choose to play?